Welcome to Trading a Smaller Account webcast. I'm Connie Hill, sitting in for Barbara Armstrong, who will be joining us again this week. I know those of you that love Barb, I'm happy that she's going to be back here too. So you'll start to see her now and again this week. Now, I have a question for you. How many of you use Beta? Beta. We've talked a little bit about it in our class about the use of beta. Today, we're going to talk about it in regards to not necessarily total stock expectation, but also what strategy you might choose to use. Okay, so that is what is on tap for today. I am joined in the chat. I think my good friend Mike Fairborn is out there. Mike's fellow coach, fantastic trader, veteran of the markets, knows all these strategies we're talking about inside and out. I'll keep an eye on my chat to make sure I can catch any of the questions you might have. But if there's something I can't quite get to, Mike's going to help me out with that. All right. So happy to see you all here. Let's go through our disclosures and I will lay out our agenda for today. Options carry a high level of risk and are not suitable for all investors. What we talked about today is intended for education or information only. Don't consider it a recommendation. We will be using the Paper Money software application. It's what you download to your computer. It's the most robust version of Thinkorswim. Investing involves risk, including the loss of principal. Past performance is no guarantee of future results. We're going to take a quick look at the markets, see what's going on. Looks like maybe they're kind of flat this morning, maybe pulling back a little bit. We'll take a look here. We always want to do some new examples. In fact, we're going to spend most of our time on some new example trades today, but I always like to spend a little bit of time on management of trades, right? Because sometimes it's easy to get in the trade, but then once you're in the trade, then you have a lot of questions. Well, this happened now, so then what, right? How should I react? How should we view this? And if you're doing any of these example trades in your own Paper Money account, you'll probably start to have those kind of questions, and I want you to be able to have them answered here. All right. This class has some special rules. It's not a beginner class, it's more of an intermediate class, so we don't go into really deep into certain strategies, but we take the idea that you know some things and we're going to use some of these strategies. We're going to say we have a $20,000 Paper Money account. That's what Barb started out with this year. Max position size is going to be $5,000. So if we do invest in a stock, it's going to be no more than $5,000. We don't want to risk more than $400 to $500 per trade. And therefore, it's going to limit maybe some of the strategies we might be able to do. Like it might be hard to do a covered call strategy. Now, your account, whether you're deeming it smaller or maybe it's bigger and you have a small portion you're trying to really grow, it could be totally different. It could be a $5,000 account. It could be a $50,000 account. It's going to be very relative, right? So that's why we're just keeping it at the $20,000 as we position size. We're going to do it based on that, and make sure in your account that you're practicing with that you do the same thing. So we're going to focus on short to intermediate term trades. We're going to go both bullish and bearish. When we're bullish, these are the strategies that we might do. I mentioned covered calls earlier, and sometimes we might find some stocks that we can do that with, and I think we have actually done a couple of them recently. And then the bearish strategies, we'll talk about doing long put verticals, short call verticals, and sometimes we'll discuss if the market's kind of trending sideways or maybe a stock's a little bit more neutral to sideways, then we might throw in some iron condors, some calendars, and work with that. All right, so let's do this. Let's go see what our markets are doing right now. Let's head over to Thinkorswim. And on the charts, I just have two things right now. We could bring up some other things if we wanted to, but I've got a 10 exponential moving average. That gives us an idea of the short-term trend. I am using an exponential in here. Sometimes I do, sometimes I don't. Really, it's just a little bit more reactive than a simple moving average. And you notice it more with smaller time frames, say like 10 days versus a long time frame, like say a 200-day moving average, right? And the red line here is a 30-period moving average, which is more the intermediate trend. And if we're saying, yeah, those are the ones we're going to be focusing on here a little bit, makes sense. Now, right now, it looks like maybe the SPX is down a little bit, but what did it do Friday? It put in another brand new high on Friday. Just seems to grind a little bit higher. It's not like it's a popping and running, right? It's just kind of stair-stepping its way up. It's funny. We have green candle, red candle, green candle, red candle. And it's for several days. Sometimes they'll change positions there. NASDAQ's going to look very similar. We go over here to the NDX. And it pulled back. It looks like today's going to be its second day of pulling back. It did not put in a new high on Friday, although it did a couple days before that on Wednesday with that 23,969 area. So, but still higher highs, higher lows. We've got a little bit of a pullback here. Some might look at this and say, oh, we've got maybe a flag going on, kind of a sharp vertical move up here. It's not super vertical, but then maybe right now is just in a flag formation, which is a consolidation. Typically, it's a continuation situation when we see a flag pattern like this. So we'll wait for it to break out of the pattern. Okay, so we would want it to kind of break beyond this short little diagonal resistance that is the boundary of the flag. We'll take a quick look at the VIX. And it looks like the VIX popped up a little bit today. Right now it's sitting about 1620 or 1523, it looks like. So it's in a lower area. In fact, it's not the lowest it's been, but 14.30 is the lowest it's been in the last year. But it's in that area. If it pops up here, we get to 1920, 22, 23, then the volatility, we're noticing more negativity in the marketplace. We'll probably see it on the indices, maybe a real big pullback, something like that. But right now, it's not what we're seeing. So looks like we're a little bit going to stay on the bullish side of things as opposed to running out and finding a bunch of bearish trades. Although sometimes we may have some just plop in our lap and we're going to play them. Okay. There's one trade I want to bring to your attention here that is one that we're going to just follow up on here. This might be our last chance to follow up on it. So I want to make sure we do it here today. Avgo, Broadcom. On this particular stock, we did two different trades. And you don't normally do two different trades, okay, on a stock. I mean, you can, obviously, but we wanted to do some comparing with it. So we did a short put vertical, 285, 280. So 285 is our strike price here. That's our short leg. We just wanted the Broadcom to stay above it. This is the day we got in, and it has. It stayed above it. The short, that's our short vertical. The long vertical is a 295, 300 long call vertical. And what do we need the stock to do? Same thing. We got in on this day. We needed it to go up. We needed it to go up beyond 300. Would like it to stay above there to get to our max gain. These options have about 11 days before they are due to expire. Now, there was not a lot of, they didn't really differentiate themselves very much until today. Okay, today we're starting to see, okay, how are these trades a little bit different than each other? So as we come over here to the monitor tab, let's open up Avgo. And let's see here. The short put vertical is this top one, 285, 280. We brought in $1.50 of credit, and it's down to 86 cents. So that's good progress, right? Half of 150 would be about 75 cents. So it's not quite 50% of the way there. Maybe it's about 60% of the way to its theoretical max gain. And we're up on it 64 bucks, looks like. Now, when we looked at the chart, you will notice that the long call vertical actually dropped below the short leg of 300. Price of the stock is lower than that right now. And on that, we're up $35. Okay, this is the kind of separation I was hoping that we would see sooner, but it finally happened now, so we're going to point it out. Which of these two verticals is holding up better? Okay, which of these is holding up better? 66.50 or 37.50? The long vertical had more potential as far as the theoretical max gain. We knew our max on the short vertical was going to be $150. but we actually had a little bit more to potentially gain on the long vertical. It's $5 wide. It cost us 270, so we had about 230, I should say, is our max theoretical gain on it. So 230 versus 150, so maybe a little bit more potential there for profitability. But if the stock doesn't stay where you need it to, that's when you start to see the separation. So Kevin says, yeah, the SPV, the short put vertical, is the one that maybe is holding up a little bit better. Now, if we looked at this 2 days ago, and we were saying, oh, or maybe 4 days ago with this 317, and we saw the stock really move up here. And I did look at it on that day, and the long haul vertical was starting to kind of be ahead of the short put vertical as far as how much of a profitability of the trade that we could have locked in on that date. We didn't do it. This is an experiment for us, so we can see the difference between the two. And so on this day, yeah, it had been there. Now, you might look at this and you're going to say, well, we're not wrong on the trade still. Our short put vertical, man, our short legs down there, we're in fine shape. And actually today it looks like it was below 300 at one point. It's running above it now, around below it on Friday, a little around down to that area on Friday as well. So some of you might say, well, I'm not convinced that we're wrong on that trade either. Okay, but I just wanted you to see that the short put vertical in this situation seems to be holding up better. If we have an opportunity to review this in one of my other classes, maybe say like short verticals, and take a look at the short vertical later in the week, we might do that and just kind of see how the trade is going. But there's 11 days before it's due to expire. So we're in that window that a lot of traders like to get out of. We're almost to the window. 10 to 4 days is when a lot of traders will say, hey, I want to be out of the trade by this, for 11 days left, not staying in till the absolute last time you can be in there before it expires. Many traders say, I want to be out before that. I don't want to put myself in a situation that, man, I had a good gain and then it goes to a loss. They're like, oh, dang it, I should have closed it up. So some traders will just have that as a rule that they follow, that they get out early. Okay, you might not be that way, but you might. Okay, let's take a look at this. We're going to take a look at a chart here. VKTX. I'm going to bring this one up. What's going on with this stock? Looks like a nice flagpole, right? Nice vertical run, pop, 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 pop. Go from the bottom to the top. That's our flagpole. And it was consolidating here, maybe 3 days, 2 days. 2 to 5 days is ideal, but sometimes we don't get ideal. But 2 to 5 days, if it's in there and then it breaks out, sometimes you're really happy about that. Now, I like actually what it's doing. I like that it's pulling back a little bit right now. Looks like its high was at 42.10. That was the high for the year. And so we don't know. It's still a little early in the day to know if this is going to be completely breaking out of that consolidation by the end of the day. But some traders will trade based on a trade outside of the flag pattern, right? They'll get in on that. Okay, so some people might feel comfortable. Some people might want to wait till the end of the day. Since you and I can't hang out at the end of the day, we're just going to move forward with it. Okay, and let me collapse a little bit of information here. I want to draw your attention to two things. First one, I wanted us to spend a little bit of time on beta. Okay, beta of a stock tells us the volatility of the stock. So over here, you have to hit this little caret so it expands. Okay, it's over here on the left. And then you come over here to the right, and then you see beta right here. And it's saying 0.62. Well, an average volatility rating on the S&P 500 on an average stock is a value of 1. And so everything is correlated back to the value of 1. So on this particular one, it's saying it's 0.62. So if the SPX moves, say, 1 point, we would expect this stock to move in the neighborhood of about 62 cents. That's really what it's telling us. So less volatile than the S&P 500. If it were a value above 1, then we'd know it's a little bit more volatile. And depending on how much bigger than one it is, we'll have some other examples to look at. We could use that. Now, I mentioned at the beginning that maybe we could use that beta value to help us identify maybe what kind of a strategy we might want to use here. Okay. I want to incorporate something else here as well. What about this implied volatility that's priced into these options? 172, 63, 158, 152, 146. Would you say that's on the high side of things or the low side of things? High side of things or low side of things? Okay. I hope by now your answer is, oh, that's high. Yeah, that is definitely higher volatility. When we see that, and we also see a stock that maybe isn't moving super swiftly, maybe both of those could point us to what strategy. I want you to answer to yourself. What strategy would both of those things point you towards? Tell your computer screen, tell your dog, tell my cat, right? Yeah. Tell me what you're thinking. I'm thinking it might point to some selling of some sort and maybe something like a short put vertical. In a long call vertical, we need movement and we expect the stock to move. If it has a 0.62 delta, we might not be really convinced that it's going to move a whole lot. Now, this beta is calculated over the last 5 years. If there's a newer stock that says NA on here, because it doesn't have 5 years worth of data, you can change that beta. You can click on this little lightning bolt. Oops, let me get off my drawing tool here. When we click on it, it's going to bring up this window. Come down to the next box on the left to calculations, and then it's going to say beta calculation method standard. Standard means go back 5 years. If there's not 5 years to go back to, choose fast. And it'll use a shorter time increment. In fact, it'll tell you about that. If you click on that little question mark, it'll kind of give you a little bit more information. But remember this, that once you change it, it changes it for every stock. So it wouldn't just do it for whatever stock you were looking at right there and changed it to fast. Okay, it's going to change all of them. So we're going to put it back to standard. We're going to leave it alone. I just wanted you to be aware of that. Okay. Let's see. Tori says selling. I asked you what should come to your brain about right now. How do you add the beta to the underlying area? This area, you click on this little caret here. I'll click on it right now and it disappeared. If I click on it and the arrow points down, that's when it expands to get that second row on there. And there you can see your beta. All right. Hava says a short put vertical. Carol, oh, you guys are having a discussion there. That's fine. Yeah, hopefully in your mind you're thinking, not a big mover. Okay, what option strategy? Maybe something that doesn't have to move so much. And lots of volatility, selling. Okay, we're going to do a short put vertical here. Now, it does have some weeklies, but we're going to use this monthly here because that's where the open interest was that looked the best to my eye. Yours could be different. You could come out here in one of the weeklies and maybe find enough interest, open interest in the contracts that you might like. We're going to go ahead here and we're going to use, let's see what our choices might be. We've got a 38 delta here. We've got a lot of 30 deltas, but the open interest is showing 0. Nothing out here yet. So this lets us know, hey, these are really new. They may have just started publishing them to be traded today. So you can see at the $2.50 increments, that's where we're seeing lots of open interest. So for us, we're going to have to stick with something in the 250 increment. If it was a week later and there's lots of open interest here, you might choose, something else. You'd have an opportunity for that. So we've got a 38 delta, a 33 delta, and then the next one's a 27 delta. Okay. Lots of implied volatility here, which makes this one a little bit interesting. And I want to just check one other thing here. I want to make sure that my column is showing probability OTM or probability out of the money, and I believe that is. So that's the probability of the option expiring out of the money come options expiration day, right? So on here, let's start with this one. Let's start with the 32 delta. We're not going to do a ton of contracts for our account here. Let's go 37.50, 35. So we're just going to say sell vertical. Going to pick the next strike price, and we are going to just go change it. We're going to change that to 35. Actually, we'll just come up here. 37.50 to 35, and it's going to give us about $1.15 credit. Okay. So step one is looking at the chart. Does it have an entry signal? Then saying, okay, what strike prices? Is there some open interest here? We could put something together. Yes, there is. And then is it enough juice in there for the squeeze? Let's use our little calculator here. So we have 250 minus $1.15 is going to leave us our net theoretical max loss. 15, which is going to be a 135. So our max gain of 115 divided by 1.35 as our max theoretical loss, that's going to be a big return. Okay. It might be bigger than some of you are comfortable with. Let's do this. So let's see what when I say that you might be not comfortable with it, let's see what it turns into. Okay, so $1.15 divided by 1.35 gives us 85%. Yowza. Some of you might be licking your chops and going, great, but I also wanted to consult the probability of expiring out of the money. It's not as high as what some traders might want for a higher probability trade. Okay, so let's compare if we were to just slide down and do the 35, 32.50. Let's see what that looks like. Say sell vertical. Going to change our strike prices there. It's going to go to 32.50. And we're going to have a smaller net debit. Okay, which is what we wanted. We wanted to bring in a lower return so that we could have a higher probability of success. And on this one, it's even at 56%. You're like, oh, so for some people, that might not meet their rules. They might have to go clear out here to get a 30-something delta. Okay, let's run the numbers on this one. I think this is probably the one that we're going to go with. Okay, so if we have 2.5 minus 0.97, that's going to give us $1.53. Okay, so let's just say 0.97 divided by 1.53. Let's see what that percent gives us. This one was like 85%. Let's see what this one does. So 0.97 divided by 1.53, our max theoretical loss, still 63%. Still very juicy. Now, you may not feel comfortable at this point. You might go, that's just too volatile for me. Don't like the looks of it. Let's go see. I mean, the short strike here is 35. Where is 35 here? 35 is clear in the heck down here. So that's a pretty decent margin of error. Okay, we're going to go with that one. That's the one we're going to use for our class. Okay. For our example trade here. All right, let's do it. If 153 is our max theoretical loss and we're willing to risk up to $500 per trade, how many contracts can we do? We can do 3, right? Well, we could do 4. 500 divided by 153. Now we're going to stick with our 2. We're going to do 3 contracts here. So we're going to get rid of this one that might normally be the choice. It's a 30-something delta. But because the implied volatility is so high, we're not going to go there. We're going to go 3 contracts here. We're going to do a first trigger sequential. And then it's helpful if we put in an exit order here. An exit order that says, we'll be happy if we get X% of this 97 cents. And you get to decide what that X% is. For this example, we're going to say 70%. If we get 70% of it, then 30% is left. So we're going to multiply this by 0.3. That's going to say go buy it back at 29 cents. Create an opposite order here. I'm going to put it in here at 0.29. And we're going to make it good till canceled. So the system, Thinkorswim software, can go out, lock that in for us if it happens while we're doing something else, right? We don't have to try to stare at the trade and see how close it's getting and try to capture it, right? Just let it do its work. And we're going to hit confirm and send. We'll send this to our trading a smaller account bucket. Okay. So it looks like you don't have any questions there, so we're going to carry on. Okay, let's take a look at another setup. Again, we're going to use our beta and our implied volatility together. On this one, let's see if it's looking as good as it was earlier. We're looking at Micron. All right, on Micron, what are we seeing? It's been trending up, not quite up to its previous high, but it's making higher highs, higher lows. And today, it looks like we're getting a bounce off this 10-period moving average. Now, it's not the close of the day. It doesn't look like it is in a neighborhood to close above the high of the low day where it is right now. But some might consider it a bounce. Some might also pay attention to the candle formation that it is right now. It's not the true formation until we actually close. So we don't know if it's really going to be what in this case is a harami. Which typically is a little bit of a reversal of momentum here. It's indicating maybe a little bit of a move up. Not a tremendous move up, but a move up, okay? So some traders might like that for an entry. We're going to come out here. We're going to look at the beta as well as implied volatility here. And on this one, 1.45 beta. So something quite opposite of we saw on Vertex, right? This one would move essentially the price of the stock we would expect to move about. It's not perfect. It's not, doesn't mean it's actually going to happen exactly that way. But it's saying over the last 5 years, volatility has been such that we would expect a move of about $0.45 for every dollar that the SPX moves. So more volatile than an average stock on the S&P 500. Is it a ton more volatile? I'm going to say it's significantly enough volatile, okay? So it gives us the idea this stock likes to move. Now, implied volatility, if we come and say, well, what's being priced in here? 48, 46, 45, 44, 47, 50. I'm going to say it's a little bit in a higher range, but not super high. Vertex was super high, having percentages over 100. But this is above 35, so we'll say, yeah, it probably falls into that high zone. Okay, now together, those two things, beta, stock likes to move, volatility, somewhat high, but not extreme. What in your brain, if you connect those two things, what kind of a trade do you think you might come up with? Okay, sometimes it's going to be a constraint of the kind of account that we're in. For example, I'm going to open up these options here, although got Micron up here. Looks like it's got a lot of zeros in here as well on the September 19s. I'm going to go to September 12th. Let's see if the strike prices I was looking at earlier still look like there's enough activity out there. I was looking here. We've got a 122 strike, which is right at the money. I was looking at a long call vertical. I don't know if any of you were eyeing a long call vertical, if that's what came to your mind. And it doesn't have to, right? You may pick something totally different. If we were looking to sell a put here, we couldn't, because if we had put to us 100 shares of this stock at a buck or $122, that would take up over $12,000 in our account. So we'd know, okay, that's totally off the table. Got to do some sort of a vertical. Okay, let's put together a long call vertical. I'm looking here at doing 122, 124. Now, it'll start us out here with a single here. And the open interest isn't as high as I might like it to be, okay? If you're okay with it, somebody's just doing, say, one contract, they might be okay with that. This is kind of nice here. Risk 50 cents to make 50 cents, right? Because 1 minus 50 is 50. So risking 50 to make 50. So looking at 100% theoretical return. I'm going to spread it out a little bit. Hopefully it doesn't drop too much. Let's see here. Oh, okay, 98. And it might waffle around in here a little bit. So we would be risking 98 cents to make $1.02, right? Because now it's 2 minus 98. Okay, let's fly with that a little bit. All right. Return-wise, just kind of in our head, we can tell that it's going to be maybe a little bit above 100% return, even though we're going to target something a little bit less than that. Okay, let's come down here and take a look at it. Did any of you think long haul vertical in this scenario? I'm curious. I told you to tell your dog or your screen or somebody, right? Yeah. If implied volatility goes up, yeah, that'll increase the price of an option. Now, the stocks that we were working with today, none of them have earnings coming up, right? We're kind of staying away from earnings on this particular aspect. Okay. We can risk 102. We can do 4 contracts here. Okay, so we are going to do 4. We're going to do a first trigger sequential. We're going to create an opposite order here and say, okay, if you get to a certain area, go buy back. Okay. What is a significant amount to you? What would you feel comfortable with? Feel comfortable that maybe you weren't leaving too much on the table and comfortable enough to maybe take a gain and move on. Okay. Only you can decide what that is. On this one, let's go 75%. Okay. So 102 is our max theoretical gain times. So we're going to go 0.75 if we'd be content with getting 75% of it. Last trade we did 70. We mix it up a little bit. That's going to be 76 cents. And I'm going to say plus 0.98. And we should go buy it back at $1.74. Okay, that's what we're going to do. We're going to buy it back at $1.74. Going to put it in here, good till canceled. And send it over to our class account, trading a smaller account. Sending that on. Thank you for answering that, Ricebird. Ricebird says, you know, at 50% plus, I'm happy, right? He's not saying I've got to get everything out of it. And that's one approach that some traders like is like, let's grab what we can and kind of bring it into the account, solidify this trade, and take risk off the table and find a new opportunity, right? How many of you have ever had the situation where you were up on a trade and you're like, this is so great. I am doing so awesome. I'm so smart. And you're thinking, this is easy. And then maybe the next day or later in the afternoon, man, maybe things change. The momentum drains out of the stock. Maybe some news broke that caused the stock to go down. Could be something pertinent to the stock, or it could be just something out in the marketplace. Could be something in Europe, right? And you're like, dang, I really should have locked in my profit. If you've ever had that experience, it only takes a time or two. Some people will learn the lesson about one at the first time. Some people, like me, it takes maybe 2 times or 3. Okay, till you're like, okay, I get how this works. And that's why we tell you maybe consider doing something like that, right? So that you're not risking a lot more to pick up a few pennies when you've got a big chunk of what the initial gain has been. All right, Ricebird says, yeah, I've been there for sure. I'm sure Ricebird is not the only one, okay? But these little trades, they add up, right? The value of them adds up. And so that can be important. I hope you've become a subscriber to our Trader Talks channel. It makes it easier for you to find our content. Now I'm going to grab this one. We're going to come over here. Here's our Trader Talks channel. Right now, we're doing trading a smaller account. Next up is going to be trading with technical indicators with James Boyd. You guys are going to want to stick around for that as well. Does always a fabulous job. I should be out in the chat on that one. Okay. But we'll organize our content in areas that might make it helpful for you. So something I've been working on is doing some little bite-sized content that are just short videos, less than 10 minutes, about using the Thinkorswim platform. How do you build your own toolbar? How do you set up your own custom columns out there on the trade tab, right? Things that you're like, yeah, I want to know how to do that, right? And I just give you a short video. You can just watch that and go change that on your Thinkorswim if you want to. Now, something you might really like to take advantage of are playlists for our different classes, okay? Mike Fairborn's here. Mike teaches a lot of really good classes that, I should say really good classes. They're all really good classes. But he has some that are swing trading. I think that's on, that might be on Wednesdays. He does think scripting. So how do you work with these little columns? That's Mike's class. And I'm just going to kind of look for Mike's face, although he might not have taught it the most recent. So his face might not be on here, but it is. Think Script Studies on Thinkorswim. You can go back, you can look at his classes that he's done, pick up on some of those calculations. He's done some creative things with it. So if you're feeling a little bit more advanced, you might want to consider taking advantage of that. Okay. All right, let's look at another one here. And I have like 2 or 3, so I'm just going to see if this one looks the best. If it does, we're gonna take it. Applied Digital. This stock, you can see, was having some resistance around that 15 area. Ran up to it, kind of made a cup and handle type pattern here. And then what's it doing today? Today it looks like it's breaking out above it. Again, we don't have the close of the day. We won't have that yet. It's already got above average volume, which we love to see on breakouts. Typically, that's an indication that institutions and others are buying into the stock, and typically institutions, for the most part, are not necessarily quick turnaround trades. So it gives you a little bit more confidence that the stock's likely to stay there. Okay, so we're going to look at this one for a breakout type entry. Okay. Now let's go to the trade tab and let's look at its beta and volatility. So its beta, holy cow, would you look at this? 6.557. That's a holy cow, okay? S&P moves $1. What does this stock move? $6, $6.50, okay? This thing is really quite volatile. It's got a ton of trading activity here. Look at this. Today already, it's got over 51 million shares traded. Okay, so this thing has some things going on. We would expect to see liquidity in its options. If it's got that much on the volume of the stock, yeah, we would expect that in its options. Now, what I was looking at on this one, though, let's go ahead and collapse the September 12s. We've got some higher volatility here as well. So in your brain, what does that kick off? What kind of a trade? Super big moving, lots of volatility. And there's not just one answer when I ask you this question, but there might be some preferences that you come up with. Okay. The idea here that the stocks move might lend that idea to say, well, maybe we should do a buying strategy because maybe it's likely to move. But maybe you look at the implied volatility and go, well, maybe we should sell some premium because it's really high, right? And so there's not one perfect magic answer. Yeah, maybe ChatGPT could give us the one perfect answer according to AI, at least that AI, right? Let's come down here. We're going to open the September 19 options here. Debbie says, maybe a short put vertical possibility. Yeah. Let's do this. Look at the open interest out here. We're going to do a short put vertical. Is it likely to run? It could, because this high beta. But let's see how far out of the money I was looking here to sell. This one's kind of interesting. You can see big number 0, big number 0. Okay, so that is telling us, okay, likely the 50-cent increment options were just barely added and it doesn't really have a lot of activity yet. Sometimes they really will pick up a lot and sometimes they don't, okay? But we've got, let's see what we've got here. We've got a 35 delta, a 26 delta, a 17 delta, a 12 or 11 delta. That's going way out of the money here. Let's see if this still looks fairly decent, what I was looking at. Earlier, I was looking at selling the 14 buying the 13. Okay. If the stock has pulled back a little bit since I did that, we'll still take a look and see if going that far out of the money still gives us a decent return. Looks like the probability of expiring out of the money right now is 65%. Okay. And we're going to separate this. We're going to make that 13, a 29-cent credit on a $1 wide spread. Is that juicy? Yeah, that's pretty juicy. Okay. If we take 0.29 divided by 0.71, that's like 40%. So you might feel comfortable there, you might not. For our example trade, we're going to use it. And knowing that basically what? $1.31 here. We do 500 divided by 131. We could do 3 contracts. So we'll put in a closing order here. First trigger sequential. Create that opposite order. We're going to say, all right, what's our profit exit percentage point? Let's see, what if we get of that 29 cents, whatever you're comfortable with? Somebody had thrown out here earlier about 50+%. Let's go with 50% on this one. Okay. Some of you might like that idea. Some of you might not. You're like, no, it's not that much money to begin with to do 50% off of it. Okay. Which I would get. So half of that's going to be what, 15 cents ish, right? So let's go. We're going to buy it back here at 15 cents. And that would be locking in about 20% of the gain. I might actually here even do, let's go 16 cents. Okay. And we're going to make it good till canceled. Let the system handle it. Now, question always comes back is, would you get out of this trade if it goes against you? And the answer is you absolutely want to have a backup plan. What would that backup plan look like? Well, that backup plan would look like possibly closing the trade altogether after analysis of the stock. For example, if this stock broke down below this breakout area significantly, we might go, if it came in here and put in a lower low after the breakout, maybe something lower than here, then from a technical chart perspective, you might go, it's broken apart. It's fallen apart. We've got to get out of there. In which case, you could close the trade altogether. You could also buy back the short put and say, all right, the long put actually should be in pretty good shape. You lock in a pretty healthy loss when you buy back the put. But the expectation is if you have room for that trade to continue to run, like it's got 30 days left or something, then in that case, yeah, absolutely, you could hold on to that long put and say, all right, let's see if it makes up the difference. But you want to make sure things have changed. You want to make sure the trend has changed. You don't do it because you're nervous and down on a day. Okay, you really have to look at it and be convinced that you were, say, wrong on it. All right. Is the number of contracts correct? Did I do something wrong there? We should have a conditional order to trigger that price. Well, we were just going to do it if it met that limit price. Okay, if the system looks at it and it's basically can show, oh, we can buy it back for 16 cents. We'll go buy it back for 16 cents. Okay. And it'll put that limit order in there for us on let's see. I'm just going to go back real quick. We're almost out of time here, but let me just go see if one of you are trying to tell me something here. Thought one of you might be saying that something got filled on the exit order, but it doesn't look like it. I think it just filled, and then we've got this one's not filled yet, so we'll take a look at it. I'll make sure that it gets filled. If it's down to 22 cents, we might not really pursue that one. We'll see what happens. Looks like something's changing there. All right, you guys. 500 divided by 29. Andy says a 7, but 29 is the gain. 71's the risk. Okay, it's a short put vertical. We're bringing in a credit of $29 per contract. So the reciprocal of that, 1 minus 29, gives us the 71. So it's the 71 we divide into the 500, and that's where we get the 3 contracts. So long verticals and short verticals are calculated differently from each other. Well, Mike, thank you for helping me out here in the chat today. I appreciate it, and I'm sure these folks do here as well. My time is up, but if these are strategies you're really wanting to master, really want to understand, start doing paper trading on it. I've had people say, well, how many paper trades should I do? A whole bunch. Okay, do 20 of them, do 15 of them, do a whole bunch. So you're feeling like, I get this strategy. I know how this works. Oh, yeah, I'm seeing this. Yeah, that's what I want to do. I want to go buy it back or whatever the case may be. But if you never do the practice trades, it's so much harder to learn. It's hard to learn just watching me or Mike or whoever just going through the motions. Okay, so I want you to do your own paper trading, and you can use these example trades if you want. All right, you guys, coming up, James Boyd's going to be here at the top of the hour. Go get a drink, and he'll be doing trading with technical indicators. So we'll see you there in just a little bit. Bye-bye.